11 great reasons to carry a big, long mortgage, according to Rick Edelman. We shall see. If you're wondering why I'm doing all these articles, I'm just catching up. I got a million articles that people sent me. A lot I delete, some I talk about, but I try to get these cleaned off on my email, and then I'll go back to doing whiteboard stuff. Probably another day or two of just knocking out these articles, because I do like to read them. I think they're interesting, and I like to share my take on it. And you may not find that appreciative. That's okay. But let's see what old Ricky says here. I don't think there's a dateline on this. Nah. Many people misunderstand or misrepresent the benefits of mortgages, and they get the key points wrong. If you read my book, The Truth About Money, with an open mind, and then by the time you finish, you will agree that you should have as big a mortgage as you can get and never pay it off. Reason number 1, your mortgage doesn't affect your home value. You're buying your home because you think it will rise in value over time. Admit it, if you were certain it would fall in value, you wouldn't buy it, you'd rent instead. In fact, your home's value will rise and fall many times during the next 30 years. You just won't get monthly statements showing how it's doing. Yet the eventual rise or fall in value will occur whether you have a mortgage or not. So go ahead and get a mortgage. Your house's value will be unaffected. So that's why owning your home outright is like having money buried under a mattress. Since the house will grow or fall in value without a mortgage, any equity you currently have in your home is essentially earning no interest. You wouldn't stuff 10 grand under your mattress, so why stash 400,000 in the walls of your house? Having a long-term mortgage lets your equity grow while your home value grows. That doesn't mean make any sense. Having a long-term mortgage lets your equity grow while your home value grows. Well, not having a mortgage lets your equity grow while your home value grows. That's dumb. Reason number 2, a mortgage won't stop you from building equity in the house. Everyone wants to build equity. It's the main financial reason for owning a home. You can use the equity to help pay for college, weddings, even retirement. Mortgages are bad, many people say, because the bigger the mortgage, the lower your equity. They're wrong. And here's why. So say you buy a $300,000 house and you get a $250,000 mortgage. Your down payment is $50,000. And you're starting, in this example, $50,000 is your starting equity. And you want that equity to grow. Figure 8 shows what happens. By making your payments every month, your loan's balance in 20 years will be just $117,000. This supports the contention that equity grows as you pay off the mortgage, and therefore the faster you pay off the mortgage, the faster your equity will grow. But this thinking fails to acknowledge that this is not the only way you build equity in your home. That's because your house is almost certain to grow in value over the next 20 years. If that house rises in value at 3% per year, it'll be worth $541,000 in 20 years. You'll have nearly $250,000 in new equity, even if your principal balance never declines. Okay. I don't get that. So what does having I don't understand that. That doesn't make any sense to me at all. So it won't stop you from building equity in the home. Did anyone ever say, this is straw man, did anyone ever say a mortgage won't allow you to build equity in your home? I don't get that. Reason number 3, a mortgage is cheap money. Mortgages, in fact, are the cheapest money you'll ever be able to borrow. You get a loan and you demonstrate you have the ability to repay it, but how much interest will you have to pay? The more confident the lender is that it'll get its money back, the less interest it will charge you. By offering your house as collateral, you agree to let the bank have your house if you don't repay the loan. This dramatically reduces the bank risk, resulting in a very low interest rate. And he talks about, contrast, credit cards. Okay, so a mortgage is cheaper money than a credit card, so there's a reason to carry one. Reason 4 and 5, your mortgage interest is tax deductible, and mortgage interest is tax favorable. These 2 points are related, and together they give you the important benefits of carrying a mortgage. The interest you pay on loan. Hold on a sec. Paul's going to bark. Hold on just a second, because my daughter's coming home. Let's see. You guys ready? Wait for it. 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 Here he comes. You're gonna. Wait for it. It's okay. Wow, she was quiet. One sec. Here he is. He's barking. I'll let you go see Chloe. I was in good hands with his big sis. All right. The interest you pay on loans to build, buy, or substantially improve a qualified residence is tax deductible if you itemize your deductions. The deductions is taken at your top tax bracket. Thus, if you're in a 35% tax bracket, every dollar you pay in mortgage interest saves you 35 cents in federal taxes. You can save on state income taxes too. If you're in a 32% tax bracket and you get a 5% mortgage, that loan costs you 3.4% after taxes as shown in figure 8. Meanwhile, you invest the money and earn 5%, your profits are taxed only at 15%. How many people are itemizing anymore, Rick? You might be dealing with the people in the 35% tax bracket, but there ain't that many people in the United States that is. So that's, again, another silly argument, but okay. I get what he's saying. Is tax favorable relative to qualified dividends or long-term capital gains? Actually, not necessarily. Because if you're deducting, well, I guess if you're in a 35% tax bracket, yeah, I don't think so. I'm not. This whole thing is silly. It's getting sillier by the moment here. All right. Reason number 6: mortgage payments get easier over time. Carrying a mortgage actually gets to be fun. My father used to love to talk about his mortgage, all $98 of it per month. You see, he and my mom bought their home in 1959 with a whopping $19,500. Yet my dad used to tell his father how his father thought he was crazy. How in the world was my dad going to be able to handle such a huge payment? After all, my father was earning less than $3,000 a year back then. To spend $1,200 a year on mortgage payments, my granddad thought he was nuts. Of course, by the 1970s, Dad was laughing about it. Why? Because his monthly payment in 1974 was identical to what he was paying for 1959. Yet his income has risen steadily. Thus, the mortgage payment had become insignificant when compared to his income, not to mention the fact that his house had grown substantially in value. You probably remember struggling to make your mortgage payment when it was new, but over time, that payment becomes cheaper relative to your income. How many people stay in that same house for those 30 years, Rick? What happens is people move up. Not everybody. I get that is probably one of the arguments to make. It's not fun. I'll just tell you that right now. But I get that. You're fixing your payment in an inflationary economy. That inherently is a wonderful, wonderful thing to do. Fixing your debt level while the cost of living goes up. That's inherently that's one of the benefits about inflation. It allows debtors off the hook for their debt without question. I'm not sure I'd build a retirement plan around that, but okay. Mortgages allow you to sell without selling. Have you noticed your home is worth much more than it was 10 years ago? You might be worried that your home's value will fall. If you're afraid that your home value might decline, you should sell the house before that happens. But you don't want to do that. It's your home after all. You have roots in the community. Uproot the kids. No selling is not a practical idea. Still, you fret your home's equity is at risk. Can you protect it without having to sell? Yes, simply get a new mortgage and pull the equity of the house. It's the same thing as selling, except you don't have to sell. Here's how it works. You bought your house for $200,000 with no money down. Further, let's say prices have skyrocketed and your house in your neighborhood have been selling for $500,000. You fear that the prices will fall, dropping your home's value to $400,000. If you sell for $500,000, you would, and pretend you still owe the bank the full amount of the original you'd pocket $300,000, but you don't want to sell, so you just refinance and get a new loan for $500,000. You now have $300,000 in hand, just as if you sold the house. Obviously, this is an extreme example to prove a point. I'm not necessarily suggesting you actually get a new mortgage that's 2.5 times bigger than your old one. Why? You just said having a mortgage is and don't forget the tax limitations regarding the deductibility of the large new loan. Borrow the money now because you won't be able to do so after the house falls in value. Dude, do you not know how freaking cash out refis work? You don't get the cheap money on a cash out. I'm not suggesting you'd want to owe more on the house than it's worth, but you just did suggest that. You said basically you're going to take an option against it to sell it as a refi now at $500,000 because you think that it's going to go down. Reasons 8 and 9. Mortgages allow you to, I knew it would come to this, invest more money, invest it more quickly. It also allows you to create more wealth than you otherwise would. As I mentioned, reason number 6, people get big mortgages on the first home simply because they don't have a choice. You're excited about buying a home, and even though you don't have much money, you have a good income, 2 good incomes, and you're like many couples, if you're like many couples. Some years later, with a growing family, higher incomes, and newfound equity in the home, you're ready to move up to a bigger home, which violates number 6, doesn't it? About old dad staying in the same place? Hey, let's see here. Should you use all your cash? Should you use all your cash and make a $300,000 down payment, or should you pay only $60,000 down, which is 20% of the purchase price? If you use that $300,000 to buy your new home, your monthly mortgage payment will be 0. If you make a smaller down payment of $60,000, your monthly mortgage will be $1,146, assuming a 4% 30-year mortgage. Does that include tax and insurance? I don't know. I guess it won't matter because both are going to have homeowners and taxes. This explains why so many people would prefer to make a big down payment when they buy homes. A big down payment transfers to a small monthly payment. In this case, it'd be 0. But the people who are trying to ask you to choose between big monthly payments and small monthly payments are lying to you. Yep, they're tricking you by asking the wrong question. The correct question is not about the amount of money you want to pay monthly, but the amount you want to invest. It's about wealth creation, not debt elimination. Here's a question you should be answering. Would you rather invest $240,000 right now as a one-time deposit, or $1,146 a month for the next 30 years? Obviously, you prefer the strategy that results in the higher profit. Thus, while a low mortgage payment lowers your overall expenses, it lowers your overall wealth. $240,000 now versus $1,146 on a monthly basis over 20 years. You'd have $600,000 versus $900,000. Oh, let me get somebody. Hold on. Come here, handsome. Come here. You got an addition to the family who just want to come in and check on his old pops. All right, here we go. Come on. Want to come over here and sit with me? All right. Come here, buddy. Oh, yeah. There we go. There we go. Someone wants to be on TV. Someone wants to be on YouTube. All right. So, I mean, I hate to... I wonder if the people in Japan thought that when they leveraged to the hilt their real estate that they had, because in the late 1980s it was going like gangbusters. You took loans against it, man. Look, and you got hammered on that. This is the same thing. And I don't understand too. If Rick is so certain on this, why would you not want to take the biggest mortgage, do 100% loan to value? That's what I don't get. Mortgages give you greater liquidity and flexibility. To help you understand this, let me introduce Nervous Nick and Smart Sam. All right, this is nuts, dude. All right, so let's see. So if Nick is so obsessed with getting rid of his mortgage that every month he sends an extra $100 to his lender. He knows that the more he sends in, the faster his loan will be paid off. So compared to Sam, he has a smaller mortgage and a shorter mortgage and a lower interest rate. He's added money to it each payment. It shows you what will happen. Smart Sam is paying $438 less than Nervous Nick, but Nick doesn't mind. He doesn't mind the extra money cost because he knows he'll get rid of his mortgage quicker. But over the next 5 years, Smart Sam makes his minimum monthly payments, and instead of sending an extra $100, he puts into an ETF. There you go. All right, so he invested at some. Okay, so the whole. All right, I can't take it. You'll never get rid of your monthly payment no matter how hard you try. Well, I agree with that. I mean, there's never going to get rid of principal and interest, taxes and insurance. I don't know how this guy gets away with this stuff right here. If he were to, how do you literally, even Pablo says, how does the financial industry, when they're trying so hard for the fiduciary model and all this, say, I just don't get how you say this stuff. I mean, look, I don't get it. I mean, if I were to write this when I was at USA, it'd never go through. Why? Because they say, we can't say this. And look, Edelman writes his own thing. I don't care. But I mean, if people were buying this, following his stuff, I mean, think about it. If you're a client of Rick Edelman and you followed this and the market fell, I don't know, the housing market fell 20% and your stock market fell 20%, you're in a bad place, man. And you're in a real bad place. And would he actually propose that his clients do this? I don't see how you get away with that. How can you be considered I just don't get it. I don't get the whole thing. This is why I don't understand this whole fiduciary best interest stuff, because She can make an argument that if you got this, you would have that relative to your mortgage, but that argument is fleeting because it all depends on circumstance, and we don't know. The one thing we do know, though, is carrying debt into retirement is not a good thing, my friends. If you're relying on the stock market to give you returns above and beyond your mortgage interest, and hell, even not even your mortgage interest, just your freaking mortgage payment, that's a nerve-wracking situation. You're nervous, Nick, and you should be, especially when you're sitting there thinking, well, Rick Edelman says, this is nuts. So, all right, well, I figured I'd share that with you. A guy sent this, my man, I'm not sure who sent this to me, but this is bad. All right, we'll see you.